So I'm trying to do the adult thing and save my money. I have some lingering debt that I finally paid off. I was so excited to be done with this huge loan. Now, when I check my credit, I can see my score dropped. How and why, Cap? This makes no sense. Why does my score go down after reducing my debt? I thought having lower credit utilization was a good thing.
The credit system in the US has many flaws. I'm Cap, and welcome to Screaming Lincoln's Consumer Credit Series. Loans can be tricky when it comes to credit scores. To understand why this is, let's look at the credit mix factor of a credit score. There's two types of credit accounts that make up the credit mix factor. Revolving accounts are credit accounts whose balance can go up and down over time. The interest rates on revolving accounts can change as well. The rates are usually based on the prime rate as set by the Federal Reserve. So when the prime rate goes up, like it already has in early 2022, then the interest rate for revolving accounts goes up too. Credit cards and lines of credit are the most common examples. Installment accounts are credit accounts whose balance only goes down over time. Interest rates are fixed, and set monthly payments are expected every month. Because the interest rate on installment accounts is fixed, they cannot change like revolving accounts do. These fixed terms are important to many borrowers, especially homeowners who are rushing to buy a home when they realize interest rates are going up. They want to lock in those lower rates because they cannot be changed on conventional loans. As it relates to credit mix, borrowers will want to have one installment account reporting in their credit history. By having at least one of each type of credit account, borrowers can essentially max out the credit mix factor of their score. The maximum amount of points to be expected from the credit mix factor is 55 points based on the range of points allowed in most traditional FICO models. No one can say with absolute certainty how these 55 points get allocated across the credit mix factor. But if it plays out at an even 50-50 split, then borrowers can expect a 25 to 30 point drop after an installment account is removed from their credit history. I've heard the same experience from many other borrowers after they pay off their only reporting loan in their credit history.
Must have at least one installment account reporting to max out credit mix. What about revolving accounts then? Can I get by with just one?
Revolving accounts are different. For some reason, having more revolving accounts will increase a credit score, especially when there is monthly activity and a payment reported on all of them. The same rule of having more accounts does not apply to installment accounts. One installment account is all you need.
Keep one installment account open, then keep as many revolving accounts open as possible. How come sites mention having specific loans like mortgages or car loans in a credit history? Does the type of installment account really matter?
That's a question that is specific to every lender's varying criteria. No one can give an honest answer without knowing the secret sauce behind every lender's algorithm, which can be much different from one lender to the next. However, the score's credit mix factor will be maxed out with a single installment account and multiple revolving accounts.
Okay, the hard part is keeping an installment account reporting without paying too much in interest every month. Any suggestions?
True. Sad part about most loans is that the interest accrues from day one. Finding a way to keep the loan reporting and paying little to nothing in interest will help. I have a video covering the secured loan technique, which provides more detail about what to look for. Besides the secured loan technique, there are credit builder loans offered by fintechs and credit unions that provide a decent option to get these loans reporting for a small amount of interest every month.
I think I got it. Credit mix makes up 55 points of a score based on the assumption that I already have a score to start with. Most sites say it makes up 85 since they apply the ratio to borrowers with no history or score at all. I've had a score for years and want to ensure I'm doing my part to max out each factor. To max out the 55 points, I'll get one loan and as many credit cards as possible reporting. While this will improve my credit mix factor and likely max out the 55 points possible, lenders have other factors to consider beyond having an excellent score. At least I'll know I'll have the credit mix part covered when I apply with this knowledge.
Good enough. Remember, getting an excellent score doesn't translate to automatic approvals from lenders. The credit score is just one part of the approval process. But knowing how to max out the credit mix factor will ensure an easy 55 points towards a score. Have you noticed a score drop after paying off a car or a student loan? Let me know of your experience in the comments. Hit it, Steve.